Hi there, welcome to Kneppy Invest. It is October 31st as I record this video, which means a few things. First of all, it is Halloween. Hopefully no trick-or-treaters will come calling to my door later tonight because I have no candy and I honestly don't want any eggs thrown at my door. But history shows we don't get many trick-or-treaters in this area, so I hope that continues tonight. Secondly, taxes have to be in by today, so hopefully you have filled in your tax returns and hopefully you got a refund. But most importantly, it is the end of the trading month, which means I have to give a performance update to the performance of 3 portfolios. And those 3 portfolios are the group portfolio and 2 of my own personal portfolios using different strategies, a short-term momentum and sentiment technical strategy, and a long-term buy and hold strategy that I've been using ever since I started investing. For those who haven't seen one of these videos before, the group portfolio is simply a portfolio that contains companies that the viewers of this channel decided upon were the best companies to hold over the next 5 years. The personal short-term sentiment and momentum portfolio is something I've been testing over the past few years. I did test it quite recently in 2020 and it did perform quite well. However, I have neglected it over the past few months, and that neglect can be seen in the results or the returns of that portfolio. And I'm way more comfortable in using the long-term buy and hold strategy that has been successful for me over the past, well over a decade now, as the strategy that I always go to, and you'll be able to see that in the returns of that portfolio. So before we move on to how these 3 portfolios have performed, I just want to talk about the overall market and where we are right now. During the last 2 weeks of October, it did look like the XGO would be up for the month. However, the last trading day decided no, the XGO had to be down for the day, because on the last trading day, the XGO fell 1.4%. I do think that was overdoing a little bit. I'm not sure why it was down by so much. And that means overall, the XGO was down about 9 points or 0.12%. At the end of September, I was a little bit bearish about the future of the XGO. It looked like it could be heading into a downtrend, but my thoughts did change during the last few weeks of October, because it did look fairly similar to what happened in September, October of last year. And as we moved into November, we saw the market really tear away and move to the upside. I think that's a possibility as we move into November this year. Now, history doesn't repeat, but it does rhyme. So even though it did look like it was fairly similar to what was happening last year, doesn't mean that's exactly what's going to happen, but it could happen in a very similar way to last year. We'll just have to wait and see. So I'm neither bearish nor bullish right now. I think it could do many different things over the next few weeks. It could go up again, could go down, could move into a downtrend, could move into an uptrend. There's still a lot of uncertainty in the world, and I think that uncertainty is playing on the minds of a lot of investors in the world at this current point in time. As we take a quick look at the XGO monthly, I just wanted this to be quick because I do show this chart in my monthly state of the market video, but it's good to just see where we are in the monthly time frame. And the XGO has been trading in a channel, upward sloping channel, since the end of the global financial crisis. And the only time we've gone outside that channel was during the COVID-19 financial panic for a brief period of time. And then we saw the XGO and markets around the world rapidly rise to the top of the channel by September of this year. And as soon as we got to the top of that channel and hit the channel, we saw some selling come in, and that's why we had a down month in September. The 1 month candlestick for October is a doji, and that really perfectly explains where I am right now. That means I am neutral, neither bearish nor bullish, and the doji candlestick perfectly explains that. It's neither bearish nor bullish. The bulls aren't winning, the bears aren't winning. So just look up doji, just Google it, And that's perfectly explains where the market is right now. There's bulls aren't winning, the bears aren't winning, and it also explains why I am fairly neutral at this point in time. Now, on to the performance of the portfolio, starting with the group portfolio. Now, I had been using ComSec in my previous videos, but I reverted to ShareSite for a couple of reasons. The first reason is the ShareSite table includes dividends. I do think it's highly important to include dividends when you're talking about your overall returns. ComSec doesn't do that in their tables. You have to actually figure it out yourself. So what we've got here is one column of capital gains, one column of dividends, and a return column as well. Now, I'll talk about the returns of the group portfolio in the next slide, but I just want to talk about individual companies' performance in this slide. And the one problem I do have with the group portfolio is that two companies are doing all the heavy lifting when it comes to this portfolio. And those two companies are Novonix and Lake Resources. Now, the one negative thing about this table that ShareSite does provide is you don't have any percentage returns, you just have overall returns. So I did have to write down some of the percentage returns. So for instance, Novonix is up or has a return of $9,000 or just above $9,000, which is up 233%, and Lake Resources is up 181%. The next best performing company after Lake Resources is Arctis, and that is up only 23%. So Novonix and Lake Resources doing all the heavy lifting, and the problem with that is if something bad happens to one of those companies, the group portfolio performance will take a hit. So you want to see those two companies continue to perform over the long term. On the other end of the spectrum, the worst performing companies include two large mining companies, Fortescue and BHP. Fortescue is down 40%, BHP down 25%. However, both companies have provided a good dividend. Fortescue almost $400 and BHP $318. But overall, a bit of negative sentiment when it comes to iron ore miners, and that's why those two companies are among the worst performing companies in the group portfolio. Now let's have a look at the overall returns of the group portfolio compared to the market. That's the main thing I want to do in this experiment, is compare the returns of the portfolios to the market. And now to the most important slide. And in this slide, we see how the group portfolio has performed compared to the overall market. And the reason this is important, for those who don't know, as stock pickers, we want to be able to beat the market quite considerably, because if we pick and choose our own companies to invest in and we can't beat the market, we are probably using the wrong strategy. And the best strategy then would be to put all our money into ETFs. Just get the market returns. So I want to see if this strategy does work. If we take a group portfolio strategy, pick all the best ideas of all the viewers, does that significantly beat the market? And after 4 months, we have to say the answer is yes, but this is a 5-year experiment. But after 4 months, the group portfolio is up 13.78% compared to the STW, which is the proxy for the ASX 200. It is only up 1.98%. Both strategies or both portfolios include dividends. So the group portfolio includes 12.8% capital gain and 1% dividends. And on the top slide, or the top part of this slide, we can see the week per week performance of the group portfolio compared to the STW. And it's just continually getting wider. On occasion, we will see the gap narrow, but usually that's when the share price of Novonix and Lake Resources takes a bit of a dip, and that dip can last 1 or 2 weeks, but then the share price rolls up again, and then the gap widens between the two. So again, I think the returns of group portfolio at this point in time are highly dependent on what happens with Novonix and Lake Resources, and that's the only thing I am nervous about the group portfolio moving forward. On to the first of my own personal portfolios, and this is my short-term momentum and sentiment portfolio, which uses that strategy, sentiment and momentum. It's supposed to really be an actively traded portfolio, but I haven't made a trade in this portfolio for over 2 months. So I have not been active, and that's against the whole point of this portfolio. I have raised $24,500 of cash because I was active in the first 2 months. I was disposing of quite a few companies. And when I look at the individual companies in this portfolio, I think some of the companies here don't belong in this portfolio. They belong in my long-term buy and hold portfolio. For instance, Aries Resources, TPC Consolidated, 5G Networks, Tesserent, even Northern Star. I think gold has long-term future. So quite a few of these companies I have in this portfolio probably belong in one of my other portfolios. So I have to be a little bit more active. Have to look at all these holdings and figure whether they belong in this strategy or this portfolio, whether they should be sold or whether they belong in one of my other portfolios. Atomos is another one I think has long-term potential. So I'm going to be a little more active in this portfolio over the next month or 2 months. I said that last month as well, but I am starting to make a few differences when it comes to my short-term sentiment and momentum strategy. I have been looking at charts a little bit more, so I do use charts for this strategy. I have been looking at charts a little bit more in the last few days, and I have come up with quite a few ideas in the last few days. So what happens when you're less active in a portfolio where you're supposed to be quite active? Well, I think the results are quite evident when we look at the returns of this short-term momentum and sentiment portfolio compared to the overall market. This portfolio is down 0.17%, underperforming the market, which was up 1.98%. And this is why I think I should be a little bit more active in this portfolio, and why I'm going to spend a little bit more time in this portfolio over the next month or so. Now on to the portfolio that uses a strategy that I started with when I began my investing life, and that is researching companies I think will be successful in the long term. This is my long-term buy and hold portfolio using that strategy. I have always been comfortable with this strategy, and the whole reason I decided to test the short-term momentum and sentiment is just to see if I can actually increase my returns over the long term by using technical analysis. Now, the whole point of the long-term buy and hold strategy is to buy into companies I think will succeed in the long term and just keep holding on to them as long as possible. In saying that, I did make one disposal in the month. That was Revison, and that was my best performing company since the start of financial year. Now, you might be confused right now because I have talked about letting your winners run quite a bit, and you might say, well, that is my biggest winner over the past 4 months, so why did I sell out of that company? Well, I do think Revison is not the sort of company where you just want to let it run because it's not profitable, not generating money. I do think there's a bit of hype about that company right now, and that's why the share price has gone on a bit of a run. So I do like to take profits when I have invested in story stocks and there's a bit of hype behind the share price increasing, because a lot of times you will see that hype wane away and then the share price fall away. It may not happen with Revison, but I decided that was the best strategy for me when it comes to that company. And then the 2 acquisitions I did made were not complete acquisitions because all I did was transfer them from my backup portfolio. So I do have quite a few companies that aren't included in this portfolio because my overall portfolio has way more value than this portfolio. But I just decided to transfer Ansarada and Australian Clinical Labs from my backup portfolio into my main portfolio. So disposed of one company and added in 2 companies. I actually have negative cash, so maybe I should be paying interest on that cash. So 1% interest on $701.07. I almost went to the next slide without talking about the performance of individual companies in this portfolio. And the best performing company over the past 4 months is the company I just sold out of, Revison. It's up almost 200% when I sold it, and that's why I sold it, because the share price had gone on a big run. I do think the valuation is a little bit stretched for a company that's not profitable, is not operational cash flow positive. The next performing company is EnviroSuite, up 144%. They did a couple raising at 9 cents, and I did actually partake in that capital raising because I think 9 cents was ridiculously cheap for a company that has significant potential in the future, and the share price has run up from that capital raising from 9 cents to current share price of 22 cents, up 144%. The next best performing company is Alexium, another company where I decided to take profits because the share price rose from 7 cents to 10 cents really quickly, which it does happen for this company on occasion because there is hype built into this company because there is this fund manager is always putting out emails, and whenever their members get that emails, you will see the share price take a bit of a hike up and then drop back. I decided to take advantage of that, and so I sold out at about 10 cents, bought back in at 7.5 cents, but instead of including it back in this portfolio, it's now in my spare portfolio. And then the next best performing companies are Beam Communications, up 68%, Ambertech, 67%, XREF, 65%, and Serata, 61%, and Superloop, 38%. Unlike the group portfolio, where you only have 2 companies doing all the heavy lifting, we have about 8 to 9 companies are doing really well in this portfolio. On the downside, the 3 worst performing companies in this portfolio all are in the same sector. So maybe I should become a little bit more diversified. And those 3 companies are Xtech, down 34%, Orbital, down 28%, and Electro Optics, down 26%. I've already mentioned that I am most comfortable using this strategy in my investing life. It has always worked for me, and it is continuing to work for me over the past 4 months. In fact, the returns for this portfolio since the start of this financial year are sitting just under 20%. I would be happy with 20% for a whole year, so my portfolio can go sideways for the next 8 months, and I would be happy if the overall market doesn't increase by a long way over the next 8 months. So I'm 10 times the market returns right now, and this is why I like to pick stocks. This is why I don't put my money into ETFs, because I personally can beat the market returns just like you can if you put time and effort into your investing strategies. I've already mentioned I do have a spare portfolio with quite a few long-term buy and hold companies that are waiting for their opportunity to move into the main portfolio. And 2 companies that I wish were in my main portfolio include PWR, which is up quite a bit when I bought into that company, and Hansen, which is up a fair bit as well because there was a takeover for that company. The takeover fell through, share price fell by something like 10%, and as soon as I saw the share price fell 10%, I decided I had to buy in because this is a high quality Australian company, and the share price is now higher than it was when that takeover bid was announced. So I'm not sure why that takeover bid failed. I'm not sure why people sold out because it failed, but that company is on the move. I actually did make 2 purchases in the last week and a half. They are Bubs and Big Tin Can. I really like where those 2 companies are heading. Big Tin Can made an acquisition, and I think that acquisition was an absolutely stellar acquisition, a really cheap acquisition of a company that's quite big in itself. And Bubs had a really good quarter. Some of the other companies in my spare portfolio include Alexium, Phoenix, which I've talked about quite often in a few videos. I was holding that company, sold out because iron ore prices were coming back, and then I bought back in because I think the market is overreacting to Phoenix, and the share price and the valuation of that company is really attractive at about 22, 23 cents. Image Resources, I bought quite a few months ago. Share price was going sideways, but over the past few weeks, the share price has started to rise up. Also, Kogan, Nitro, Appen, Catapult, Hum, and Mitchell Services. I also have quite a few other companies that I have included in this slide, but many companies that I do hold, and you might be saying, I'm just holding way too many companies. I have to cut down on some of these companies, and I don't believe that the best amount of companies to hold is 20, 25. That's what everyone is told, investors are told. They should only hold 20, 25 companies. If you hold more than that, you're just being too diversified, and you're just going to get market returns. But what I think those people are missing out on is that most of these companies are not large companies. They're very small companies. And if I was investing in only ASX 100 companies, that sort of lack of diversity, that sort of argument would hold water. You don't want to hold too many companies in the ASX 100 because then you become too diversified and you'll just get market returns. Hope that makes sense and explains why I do hold quite a few companies in my portfolio. You might be asking, how have some of those companies in my spare portfolio performed since I bought in? And the whole reason I wish PWR was in my main portfolio is because since I bought that company on the 5th of July, share price has increased from $6.76 to $9.44, an increase of 40%. LXCM, since I bought back in, is up 13%. Other good performing companies, Nitro up 15%, Hansen 12%, Image Resources 11%, Bubs already up 7.2%. And what else should I show you? Oh, tech. I do have one ETF, and that is tech. And the main reason I have that company is because I have a really high, not a dividend, what's the thing called? Distribution. They have a really high distribution, which I thought was a joke. So I just put some money into that company, and it's not a joke. I get a lot of money just by their distribution. So that's my one and only ETF. It's called Tech. That's up 2%. And that doesn't include the massive dividend or distribution I get from that company. Worst performing companies is Decmil down 32%, Appen down 12.5%, Kogan down 11%, and Hum down 11%. I bought in a little bit too early with Kogan and Appen. I just decided I needed to have those companies in my long-term portfolio because I can't pick the bottoms, and I was a little bit too soon, but that's okay because I do think those companies are fairly good value at current levels. Overall, the performance of the STW, or the three portfolios compared to the STW, the first return is from 1st of July to the 29th of October, and in brackets, I have the returns from the 1st of July to the end of September. We can see the STW is up at 0.16%. The short-term sentiment, because I've neglected it, went from up 2.12% to down 0.17%. The group portfolio had a good month, up 2.62% from 11.16 to 13.78%. But my long-term buy and hold portfolio up from 11.61% to 19.84%. So a really good month for that portfolio, up over 8%. What are some of my investing goals for November? I always have goals. Now, sometimes I don't achieve those goals. In fact, becoming more active in my short-term portfolio has been side goals. It hasn't been my main goals. But for November, this is my main goal. I want to become more active in my short-term portfolio. I want to turn around that portfolio's fortunes. I've already started that process, and a few ideas are permeating in my mind right now. The other thing I want to do and continue, I've already started this process in October, is research IPOs and international companies, particularly IPOs, because I am finding there is some really good ideas out there, because a lot of companies have listed on the ASX in the past 18 months, since about June of 2020. And I just want to see how those companies have been doing since they listed. And I've started my journey in researching international companies. It's a slow process because there's a lot of companies out there, and it's hard to find which companies are the best sort of companies to invest in. Some people would say, just look at all the tech companies. Some people say, just look at Tesla, just look at Apple, just look at Amazon. In fact, I do think Amazon is a definite investable company. I'm even thinking Tesla might be, if they really become the self-driving go-to car company. But that's just my thoughts, initial thoughts right now on those companies. So a lot more research I need in those international companies. I want to find some hidden gems, some companies that have a valuation of like $1 billion and have the potential to become a $100 billion sort of company in the future. That's all I have for this performance update video for the three portfolios, a 4 months update. Hope you've enjoyed this video. If you do have any questions about these portfolios or anything I've mentioned in this video, leave it in the comment section of this video and I will answer it in the next few days. Hopefully, I do have 4 days off now, so hopefully I'll be a little bit more active in the comment section. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.